All right, so let's go to the next section. It's on type of business entity. All right. So initially we look at the core topics on investment additions, financing additions, and dividend policy. So now we gonna look into the business entities. What are the types? And I guess you are familiar with these types of business entities. The first one would be sole proprietorship. Right. Sole proprietorship means single person owns the business. So with this type of business organization, you would be fully responsible for all debts and obligation related to your business. All right. As a single person who owns the company, so you will be fully responsible for the company's debt and any obligation related to the business. And of course, the good thing is all profits will be yours. All right, alone to keep. You don't need to share with anyone. All right, as a sole owner of the business, a creditor can make claim against your personal business assets. All right, or personal or business asset to pay off any debt. All right, so this is the important point where if you're a sole business owner and you have a bank loan and your company is declared bankrupt, you don't have any more fund to make the payment. So the creditor or the bank can come up to you and they can claim your personal assets. Right? They can take your car or uh, house. All right, in order to get back their money that they borrowed to the company. So briefly, for a sole proprietor, the company is not a separate entity. The company and the person, we look from the as though they are same. All right. Anything goes wrong in the company, the sole proprietor, the owner has to pay for it. So let's look at the advantages and also disadvantages. The advantages, of course, the number one is easy and inexpensive form sole proprietor. So you can go to SSM, the Suruhanjaya Syarikat Malaysia, and you can in a day you can get your company registered. All right, so it's easy and the cheapest, the most inexpensive among other types of business entity. The second advantage is of course the lowest amount of regulatory burden. All right. When it comes to compliance, you don't have strict regulations, rules to be followed. All right. Compared to corporation, compared to corporate. And the third advantage, of course, direct control on decision making. As a single owner, single person, you can make the ultimate decision. You don't need to share your decisions with anyone else. So you have full control when it comes to decision making. Right, so that's another good advantage because if you have a partner, you have to consult with a partner when it comes to any decision making. So now you have ultimate control. Right, it's your decision. And of course, the fourth advantage would be low organizational and operational costs. So if you take a corporate, your operations structure is long, right? It's huge because you have a shareholder, then you have board of directors, then you have senior executive, all right? You have vice presidents, senior vice president, assistant vice president, and you have executive, and you have that kind of uh, huge organizational structure. But it's all proprietor. Usually you're the single owner and sometimes you're the manager, you run the business. So very low organization structure, therefore the cost is very low. Right? In a corporate you have to pay from the board of directors until the senior executive class admin people. There are so many different rules and a lot of costs will be incurred for it. So that those are the advantages. So of course, we have disadvantages as well. So the first and the most important would be the ultimate disadvantage for a sole proprietor is unlimited liability to the owner. Alright, so what is unlimited liability? For instance, let's say the single owner, the owner invests 50,000 into a company. Alright. Later he took a bank loan worth 30,000. Alright. He invests, his capital is 50,000, he took a bank loan worth 30,000, and let's say the company goes bankrupt. Alright. The company goes bankrupt and he doesn't have any more money, no cash, nothing, no fund in the company, but the bank will still wants to get back the loan amount of 30,000. So what they do, they will go after the owner. The owner has to pay the 30,000 loan the company took. Alright, that's called unlimited liability. So in a corporate, it's a different scenario. Alright. So in a sole proprietor, you are not only the company is not only liable, the person, the single owner, the sole proprietor is also liable for the company's debt. Alright, so that's the main disadvantage. The second would be profits and losses are taxed as though they belong to the individual owner. So why is it disadvantage? It's because corporate tax is less than personal tax. Alright, when it comes to the highest tier. So corporate tax is low, right? Slightly lower than the uh, individual or personal tax. So that's why it's a disadvantage. And the third one is lack of continuity for your business if you need to be absent. All right, difficult to raising capital on your own. Okay, what does it mean? If a single person or sole proprietor owns a company, and if let's say the person died, that's it. The company has to wind up. You have to close down the company. You cannot continue the business without the sole proprietor. Alright, so that's a disadvantage. Other than that, difficult to raise capital. Alright, difficult to raising capital means you're a single owner, sole proprietor. So most likely you would have used your own funding, your savings. Alright, or you ask your relatives, parents, friends to help you out. But other than that, as a sole proprietor, it's difficult to get funding. Right? It's because your choices or options are less. So those are advantages and disadvantage for sole proprietor. So let's move on to the next type of business entity. It's called partnership. All right. Let's say among you have two or three friends. After graduate, you want to start a business. All right. Of course, you can think about partnership as a good business structure. All right. And start a business with a partner if you do not wish to incorporate your business by yourself alone. All right. So with partnership, your financial resources are combined, which means if you need 100,000 capital to start a business, if you have, let's say, four friends, each would invest 25,000. All right. So instead of 100,000, the company, if the business model fails, you will lose 100,000. But as a partners, you only lose 25,000. All right. So that's the benefit of partnership. You can establish the terms of your business with your partner and protect yourself in case of disagreement. All right. This is important even though you're friends, but once the business develops and things can go more complex. So if something goes wrong, you don't want to blame each other, right? So you must have an agreement prior to setting up the partnership. You must have a clear agreement. Is let's say each of you uh, invest capital equally, then you have equal ownership of the company, right? As partners, you would share in the profits of your business according to the terms of your agreement. Okay. So at the end of the day, you can say whatever you want. You say partner A work hardest among the other three partners. Whatever you say, at the end of the day, the agreement, the partnership agreement, have the highest say. All right. So when you go to the court, we will look at the agreement. That is black and white. So you have to follow based on that. Okay. You may also be interested in a limited liability partnership business. Okay. Usually you have general partners. All right. There are special case where we call this as a limited liability partnership. So this limited liability partnership does not take part in the control of the management, but would be liable for debts to a specified extent only. Okay, the good thing about limited liability partnership is you don't have you don't need to involve in the business. You don't need to make decisions. You don't need to control the management. All right, this will be done by the general partners. All right, it's a limited liability partner. The only loss you're gonna make is the amount of money you have invested in a company. Okay, let's say you have four friends, three of them general partners, all right, the ordinary partners. Fourth partner is a limited liability partnership, all right. So the other three partners will be liable completely for the company, all right. The fourth partner, he will only lose whatever the money he invested in the company. All right. So in the layman term, we call them as the sleeping partners. All right. So you invest capital, but they don't involve in the management of the company. All right. So what about the other general partners? The general partners is similar to what happened to the sole proprietor. All right. They will be liable not only what of the company as whole, but they have to use their own personal assets to pay off the debt. All right. So remember, the limited liability partnership is a special case. All right, only for a certain number of partnership. You cannot have all your partners as limited liability partnership. All right. You can have most of the partners has to be general partners. All right, and the one or two would be the limited liability partnership. So, right, so most of them general partners, limited number will be the limited liability partnership. All right, so let's look at advantage. Again, it's easy to start up a partnership. The startup costs will be shared equally, so that's a good thing. You don't need to come up with all the capital as a sole proprietor. Equal share in management, profits, and assets. All right. So if you have four friends, then you have to share your profits equally, share the assets equally, and you have to manage your management also shared equally. Tax advantage: if your income from the partnership is low or losses money, you and your partner include your share of your partnership in your individual tax return. So the tax advantage is because since let's say four friends sharing the profit will be lower. All right, and you end up paying a lower tax because it falls under a lower tax bracket. All right. Compared to the full amount paid by the sole proprietor, will be higher. Okay. So let's look at the disadvantage. So similar to sole proprietor, when we talk about the unlimited liability, which means there is no legal difference between a company and the owner. All right, this is only for sole proprietor and partnership. All right, if something goes wrong in a sole proprietor, you go against the owner. All right, same goes to partnership. If something goes wrong, you go after the partners. All right, even though it's a company, even though it's a business, but there's no legally you can't see the difference between the company as an entity and the owners. All right, so you have the unlimited liability here as well, which means if the company can't pay off the debt, they have to go after the partners assets to pay off. All right, so this is again only for the general partners, not the limited liability partners. So uh, they will be away from this issue. All right. So again, that's a good thing about the limited liability partnership. Hard to find a suitable partner. All right. So that's another disadvantage. You need to find a suitable partner um, that have a similar passion, just like the person, right? So the next thing is conflict. All right. So in the beginning, you might do well, but later on, conflicts might develop. All right. And then you financially, if let's say you have two partners, one partner has signed an agreement in a company, then both partners will be financially responsible for the decision. All right. Even a single person made a mistake, even a single person broke the contract, the other partner has to pay for it. Right. So that is again the disadvantage. All right. With that, we move on to corporation, the next type of entity. For corporation, once you incorporate your business, the business is considered a different legal entity. All right, it's separate from the shareholders. It means what? If let's say you are flying in AirAsia, I mean, you can't do it currently. Let's say future, you're flying in AirAsia. All right, let's say you're flying in AirAsia, and you have an issue, you have a big issue, and you don't really like how you were treated in the flight, so you come out, you're taking legal action against the company or Tony Fernandez. All right. So tell me, do you take legal action against Tony Fernandez, who is the founder and the shareholder of the company, or against the company itself, AirAsia? Class, what's the answer? The answer is the company. You take legal action against AirAsia, not the founder, not the shareholder of the business. The reason, once it's a corporation, once you incorporate a business, you see that as a separate legal entity. All right. The only thing, the business is not alive, but when it comes to legal point of view, you take every legal actions as though it's another entity. Okay. So as a shareholder of a corporation, you will not be personally liable for the debts, obligations, of the corporation, which means the company goes into bankruptcy, but the company still owes money to banks. They won't come after the shareholders, right? So when making suggestions, always wise to seek legal advice before incorporating. Okay. So let's look at the advantage limited liability. So you learn unlimited liability earlier. So now you have limited liability, which means if you invest 10,000 ringgit and you purchase company shares, all right, you purchase sign the shares for 10,000. When the company goes bankrupt, when the companies have debt, the most you would lose is 10,000, nothing more. All right, they're not going to come up to you and claim your assets. So that is called limited liability. So that's the advantage. Ownership is transferable. Let's say you're the shareholder, you can transfer the shares to your spouse, to your children, all right, or your parents, your grandparents, passing their uh, transferring their ownership, all right, to yourself, all right. So that is an advantage. It's possible. Continuous existence. There are companies lasting for hundreds of years, all right, even though the owner is not there. For example, Steve Jobs, the founder of Apple, is no longer alive, but the company still exists, right? Still doing well. So that's an advantage. Separate legal entity, as I say, you seek or you view a company, uh, those who are like you just take all the listed companies, all the Berhad, you claim it or you seek it or you view the company as a separate legal entity. All right. The next point is important. Why? Another major reason why you want to incorporate a company, even though you can look at the disadvantages, it's expensive, it's highly regulated. The main reason is easier to raise capital. All right. Unlike sole proprietor, you are only dependent on few options: your friends, your family, your relative. But when it comes to corporate, if let's say DG, all right, DG wants to uh, expand their business, they need 100 million, right? They need cash. What they have to do, they have to issue new shares worth 100 million, and there are people willing to purchase the shares. So easier to raise capital. Once you're an established company, there are people waiting to buy your company shares, especially if you're the company performing well. All right. So unlike sole proprietor and partnerships, that is a difficulty. Possible tax advantages and tax may be lower because you're incorporated, so you pay corporate tax. Alright, so that is an advantage. Okay, let's look at the disadvantage. It's closely regulated. Alright, compared to sole proprietor partnership, you have the strictest rule. Alright, your compliance is very high. You're closely regulated. So if you're a listed company, the Bursa Malaysia will closely monitor you, the company. If anything, you're not complying, alright, they can penalize you. The worst case is they can delist your company, alright, make your company unlisted. So it's very important, it's highly regulated. More expensive to incorporate compared to partnership. Okay, extensive corporate records required. So you have to maintain accounting records, the statements including shareholder director meetings, the documentation to the government. All right, it has to be very extensive record keeping. And of course, conflicts. You can have conflicts with shareholders and directors. All right, shareholder wants to maximize their wealth, but directors might their intention might be different. All right, they want to increase their um, their income. All right, so there will be always conflict. Directors want to make one decisions, shareholders will be against those decisions. All right, there will be conflict because shareholders, most of the listed companies, the shareholders are different from the person who manage the company, the directors, right? Possible probable residency of directors. This is especially if a director is from overseas or a Malaysian citizen. So there will be a problem with the residency of the director. All right. So with that, we have completed the three business entities: sole proprietor, partnership, and corporation. So let's move on to the next slide on other goals of financial management. All right, so we already looked on the important goals, and these are other goals as well. So let's look at this valuation approach. So valuation approach is valuing the company's share price, all right, valuing the company's assets. So these are this commonly done as well. You want to know how much your company's valued. All right. The next thing is, of course, maximizing shareholders' wealth. We have already looked in depth on this. Then you have management and stockholders' wealth retention. All right. So as a director, usually they want to retain the portion in long term. Right. You want to be in power so that, of course, you earn and you have a comfortable relationship with the shareholders, and then you have sufficient share option incentives to motivate, right? The shareholders will usually give share options to the directors, all right, in order for the directors to think like shareholders, all right. So we look into this in detail. What is share option? The later chapters. All right, and the next one would be powerful institutional investors are making management more responsive to shareholders. All right, so powerful institutional investors, for example, uh, companies, the big insurance companies, all right, they use the funding they get from the policyholders, and they take the money, they invest in companies. Okay, and you have EPF, all right, Khazanah, all right, all these large corporations, they are known as institutional investors, which mean if they take a company like AirAsia, they might be EPF might hold 20% of the company's shares. All right, for Malaysian Airlines, the majority shares hold by Khazanah. All right, so these are institutional investors. So when you own majority of the company's shares, you have a crucial uh, you become a crucial decision maker, right? If you're a majority shareholders, you hold the maximum power when it comes to decisions. Okay, and let's look at social responsibility. So, what are the? Let's look at some of the social responsibility for a corporation. So, the first one, maximize the value in the market. So, one of the role is to strengthen the local economy. Right, that is one of the role. If you're a company, you started a company in Malaysia, you want to expand the local economy, Malaysian economy. So that could be a goal. Attracts capital. You want to attract a foreign direct investment. All right. Provides employment. Of course, when you start a company, you expand a business, you want to give more employment to the for the local, right? For the locals. And of course, other benefits to the society as well. For example, you are providing high quality products. And other certain costs. Okay. Increasing activities may have a mandatory rather than voluntary initially to ensure burden falls equally over all business firms. See what are the other social responsibility. So now it's become very common and very famous here at CSR, corporate social responsibility. So that is some kind of responsible for companies For instance, if you go to Sunway Pyramid, uh, they follow this environmental friendly motto, where it seems like in the toilets they don't use water, which means for the urinals they are using eco-friendly uh, bio techniques, all right, to save water. So these are the some of the corporate social responsibilities companies can do. All right, it's not a mandatory, but you can do this voluntarily for the benefit of society overall. Right. So let's move on to the next slide. All right. So the next one is the role of financial market. All right. So the financial market are indicators of maximization of shareholders' value and the ethical or the unethical behavior that may influence the value of the company. Okay, the financial market will be used, all right, to create or to show the how the shareholders' wealth has been maximized or increased, all right, and also since a listed company and the Bursa Malaysia, so you have to follow the regulations so they can monitor whether you have a dealing any ethical or unethical behavior, all right, to influence the value of the company. All right, so you have participants would be public financial market or the corporate financial markets. All right, so let's look at the type of securities that are traded on Bursa Malaysia. You have shares, you have company warrants, and you have real estate investment trusts. So let's look at shares. All right, so I think most of you already have some understanding on share. It's a security which represents the portion of owner's capital in a business. Okay. Uh, when you purchase shares, they give you a certificate in return that reflects how much of the company that belongs to you. All right. So that is shares. So if you own 10% of the company's shares, that means you own 10% of overall value of the company. Okay, whether the company is successful or failure, you will have a 10% portion of it. Okay. All right. Next, you have company warrants issued by company to give the holders right but not the obligation to subscribe for a new ordinary share at a specified price during specified period of time. All right. So there are some key uh, key terms here. Okay, so first important point here is the company give them the right but not obligation. It means you can choose to do it or you can choose to ignore it. All right, there's no obligation, so you have the right but no obligation. That's the first point. Second point is new ordinary shares at a specified price. All right, they give you option to purchase the company's shares at a certain price. Okay, and the third point is at a specified period of time. So for warrant, you have three key points here. All right, first one, you have right, no obligation. Second, specific price, and the third point is a specified period of time. Alright, so usually warrants have a maturity date after which you cannot use the warrant. Alright, so plus what is warrant? Let's say currently the share price is 2 ringgit. Okay, in 5 years the share price could increase to, let's say, From now 2 ringgit, your share price can increase to 5 ringgit. Okay, that is your forecast. If you have the company warrant, all right, you can purchase a warrant at a very low price. It could be 10 cents. Okay, if you have warrant, in 5 years time you can purchase a company share, let's say for 4 ringgit. Okay, even though the market price is 5 ringgit, you can purchase the company shares for only 4 ringgit. The reason is because you have the company warrants. All right, if you have the company warrant, you can purchase the company shares at a specified time at a specific price. Okay, that's a benefit of having company warrant. And the next one, you have real estate investment trust. Okay, real estate investment trust is, let's say you don't have the money to purchase an entire building, okay, but you still have an interest. For example, you have IGB REITs, Sunway REITs, Pavilion REITs. All right, even though you don't have all the money to purchase certain, let's say, you can't have entire building, entire business of Mid Valley or the buildings. You can purchase certain portion of it by buying the company's REITs, real estate investment trust. All right, so you might not have full amount, let's say a building worth 10 million, but at least you can purchase it for 500 ringgit. All right, when the value of the building increases, the value of the investment, your investment or real estate investment trust will also increase. All right, so that is real estate investment trust. With that, I'm completing chapter 1. All right, so let's uh, look forward for the next chapter. Thank you.